You work hard for your money. After all your hard work, you want to minimize your risks, which is exactly what you do when you deposit your hard-earned money with an insured bank. You minimize your risk because your money is insured against loss by the Federal Deposit Insurance Corporation, an agency of the U.S. government. Since that agency was established during the Great Depression, not one bank customer has lost one penny of any deposit insured by FDIC insurance. Basic coverage for each category of interest-bearing accounts is $250,000. However, it is possible to structure the balances in your accounts to have deposits in our bank insured well beyond that level. Your non-interest-bearing accounts have unlimited insurance until December 31, 2012. The key to maximizing your FDIC protection is understanding the categories of accounts the FDIC insures. There are 5 main categories of accounts for individuals insured by the FDIC, and each category has its own FDIC insurance level. The categories and their insurance levels are single accounts, $250,000 total insurance for all accounts owned and in the title of one person. Joint accounts, $250,000 total insurance for each depositor listed in a joint deposit account. Retirement accounts, $250,000 total insurance for retirement accounts of any one person. Revocable trust accounts, $250,000 insurance per beneficiary for up to 5 beneficiaries. More coverage is available with 6 or more beneficiaries, subject to specific limitations and requirements. Non-interest-bearing transaction accounts, unlimited insurance until December 31, 2012. Let's make this a little clearer by looking at how the accounts of a couple we'll call Bob and Sally are covered by FDIC insurance. For our purposes, we're assuming all of Bob and Sally's accounts are interest-bearing. First, let's look at single deposit accounts. Bob and Sally each have an individual money market deposit account, or MMDA. In addition to that, Bob has a savings account and 1 CD, while Sally has 2 CDs. The total of Bob's single accounts is $250,000. The total of Sally's accounts is $257,000. That means all of Bob's accounts are covered by insurance, while Sally has $7,000 that is not covered. Next, we'll look at the joint account category. Remember, this category is not related to the coverage of any other category. In this case, Bob and Sally have 3 joint accounts: a joint MMDA, a joint savings account, and 1 jointly held CD. The total of all these accounts is $500,000, so all the money is protected by FDIC insurance. The third category is retirement accounts, and like the others, it is not related to the coverage of any other category. This category is relatively simple. Bob and Sally each have an IRA account worth $250,000, for a total of $500,000 in retirement accounts. The $500,000 is protected by FDIC insurance. Finally, we will look at a fourth category, revocable trust accounts. These are accounts that pay out to a beneficiary when the account holder dies. Once again, using Bob and Sally as an example, we see they have chosen to leave money to their children and to each other if they do not use the money before they die. Each has a revocable trust account that pays to their 2 children and to their spouse, for a total of $750,000 in trust accounts. That means Bob and Sally together could have a total of $1,500,000 in revocable trust accounts and have all of it covered by FDIC insurance. When we put all the accounts together with the FDIC insurance available to the couple, we find that Bob and Sally can deposit up to $3 million in our bank and have FDIC insurance coverage on every penny. Here's how it works. Bob and Sally have single accounts with total insurance of $500,000, joint accounts with total insurance of $500,000, retirement accounts with a total of $500,000 insurance, and finally, revocable trust accounts with a total insurance value of $1,500,000. In addition to the individual coverage, the FDIC does provide some business and corporate coverage, as well as irrevocable trust coverage. If you want to calculate your coverage, you can go to the FDIC website at www.fdic.gov, where there is an electronic deposit insurance estimator known as EDI. EDI can calculate your FDIC insurance coverage at our bank. This electronic calculator will give you a printable report that shows whether your deposits are within or exceed coverage limits. If all of this still seems a little challenging, come in and talk to us about it. We'll be glad to help you arrange your accounts so you get the most federal insurance protection allowed. When we started this presentation, we said we knew you worked hard for your money. We'd like the opportunity to work hard for you, to help you get the maximum return on your money with maximum safety. Come in and talk to us. We'll be more than happy to help you arrange your finances so you get the maximum FDIC insurance allowed by law.